Very good morning, everyone. Thank you for joining us this Thursday morning and welcome to CapBridge educational webinar. For those of you who don't know, this is a two-part webinar series in partnership with Minterest, where we will explore and share our thoughts on how you can future-proof your portfolio. Today's session will focus on the role of alternative investments and private credit. Our list of panelists today includes Johnson, founder and CEO of CapBridge Financial. We have Sharon, Chief Commercial Officer of Mintrest, and also Alvin, Head of Investor Relations and Partnerships at Mintrest as well. Just a quick note before we begin, today's session will be recorded and will be sent to all registrants within the next week. We will also be having a Q&A at the end of the webinar, so feel free to type in your questions in the Q&A box in the Zoom chat. Okay, so without much further ado, let's kick things off. I'll hand over the time now to Johnson, founder and CEO of CapBridge Financial, and he'll be giving a quick intro to the private markets. Johnson, please.
Thank you so much. Just sharing my screen. Yep, does it work? Okay, thanks everyone for your valuable time. And
Johnson, sorry, I think your screen is the wrong one. Okay, yeah.
Okay,
great.
All right, with some technical things, and so yeah, thanks everyone for your valuable time. So today's topic is on the future-proofing your portfolio, the rise of alternative investments and private markets. So I kind of thought today to share kind of in the development and the evolution of the private market, and how this development will allow you to incorporate some of the private market investments, and also on what we at CapBridge is working on. So at CapBridge, we have two parts of the business, a dealing and security license under CapBridge, where we're able to distribute and structure investments, and a private exchange license under one exchange, whereby we can actually trade and make financial instruments. Our main strategy is around what we call FIT, F-I-T, right, which is basically fractionalized, interconnected, and tradable. You may have heard of the term fractionalized, but what does it really mean? Fractionalization simply means that we're breaking investments into smaller pieces. So it's basically a global trend now, and it essentially allows more people to participate into these investments, and it's really driven by a lot of the digital technology that makes all these subscription costs much lower now. So the idea here is to make it into small pieces so that more people can partake in the investment. So that's a fractionalization. The second one is under I will be interconnected. And most people know that it was previously quite difficult to buy US shares or Hong Kong shares and all, but now it's quite easy to actually buy all these shares now. So similarly, we see that the exchanges, be it private exchanges or public exchanges, will cross list and link up further, and various financial institutions will be all these financial instruments and all will be made to cross list on various platforms, be it the app side and all these trading apps. So we see this as a huge opportunity that we can also able to obtain and procure these new products and kind of putting it onto a unified platform, so that we can expand the liquidity pool and really achieve a win-win for all. So I think this interconnected thing is a trend of is going to be ongoing, and you can see that various public exchanges are already moving that, and similarly very similar to the crypto exchanges as well as the regulated ones. So lastly, we have T, which is tradable. So as you know, we have the private exchange license, and what this allows us is to create a tradable instrument on our platform, complete with ticker symbols and all. So through this, we are hoping to also create products that makes sense, and in the private market space that we can then allow trading through the interconnection and through the fractionalization. So that's really what is our objective, which is the FIT way. So with our fit strategy in mind, what we're building upon is really the private market space. And this slide shows kind of the various products. And probably we're going to focus on the 4 products here, which is basically the ones that we have been working on. And traditionally, these products have only been restricted to private banking, wealth clients, or family offices or institutional firms. So what we're hoping to do here is to open up the access through this fit strategy and broadening it to the mass affluent and sophisticated investor, leveraging on various digital technology and of course also on the blockchain. So here's the overview of the 4 key product pipeline that we have. So the first one is really the unicorns and late stage growth. So we have some examples here. I mean, for us at CapBridge, we also have done some of these deals here. The whole idea here, these are coming up to be quite kind of an emerging class, which I will share more as we drill down. The second category is in the real estate and asset-backed instrument. So we're working with various partners, and today we have our friends at AERA, Mintrest, and I'm sure they're going to share that more. So this is also something which everybody is very keen on, especially based in Asia, where real estate is really a very large part of anyone's investment portfolio. The third category is in the regular PE and VC fund space. So again, there has been a lot of money flowing into this, mainly because of the various macro trends in the industry, which I can drill down more. So we are also working on bringing these and giving the access to these top tier funds. And lastly, we have the fractionalized institutional grade Lisco bonds. And what this is basically traditionally these Lisco bonds are limited to ticket sizes of more than 200K. And there has been a lot of movement now. They've seen a lot of this digital bond issuance and all. There's a lot of movement now to break this into smaller pieces, and thereby allowing access to this. So this is another field that we're working on. So by maybe next one I will move forward is to drill down and to share some of these asset class, and what is the evolution of why this makes sense. So the first one is unicorns. They are basically defined as more than $1 billion US in valuation, and typically the investors will come in with a holding period about 18 months. So one examples which I can share is that we at CapBridge, we actually did a round for grab back in Q4, and of course it's public information now that they are doing a SPAC deal. So this is within the 18 months holding period that we designed. So based on our own research, we're seeing this unicorns as a new asset class now, because I think the recent valuation jumps has been pretty big. There's some data to show that there has been the valuation jumps between the previous round and the IPO round has been the highest ever within a 5-year time frame. So people have even seen the valuation jump more than 100%, right? And according to Crunchbase, there are about 630 private active unicorns now. They have raised more than 450 billion and just valued under 2 trillion. And if you think about this, right, the market cap of Apple is 2 trillion, and all the 630 companies and all, they're valued almost the same as Apple. So if you think about it in the scheme of things, there's still quite a lot of room to grow. So there seemed to be quite a surprising shift now, especially in probably about starting from 2 years back that we have seen probably in 2019. The public markets were actually valuing these growth companies at better multiples than the private side. So this gave rise to a critical shift whereby these unicorns now are attracted to go public because the public is paying up a higher multiple now. So I think this has been observed. The data has shown that. One of the things that we see this as a trend to still going, especially as what we have seen in terms of the pipeline that is coming out. So, but I do have to caveat this, right? The public market is only paying for this for unicorns which are seeing very, very high growth. So, unless you have more than 50% revenue growth type, super growth, the public market is rewarding this. So I think this whole thing, and especially now, we have even talked about the whole specs thing and whatever, this is definitely a trend, and we see this as a really new emerging asset class. Right. The next one, which I thought to tap on, is the private funds. Just last week in Financial Times, it's been reported that more than $7 trillion have actually now is available in the private capital side, and is expected to go to 13 trillion by 2025. So I think the general consensus is that there's quite a lot of money flowing into the private space is because of the low interest rate and environment, and of course due to high public market valuations. So if the public market valuations are high, obviously the upside for these stocks will be limited, and that's the reason why a lot of the investors now are turning more into the private space. However, I must say that the private fund space is very complex, and there's a whole lot of different variety of funds employing different strategies. So one does need to drill down into what is the strategies. So there are buyout funds, there are fund of funds, there's private debt, there's growth and expansion fund, there's real estate fund, there's infrastructure fund, there's natural resource fund, secondaries, venture capital funds, and all. And each fund has its own vintage and timing. So if you look at the various reports on the performance of fund, we do need to take a caveat that some of the ROIs reported really depends on various factors. But in general, in terms of the 10-year period, VCs are giving between 13 to 22% ROI, and PE funds between 14 to 17. And lately, it's been reported that the VC side has been, the VC funds have been performing better because of the slant towards all this, thematic things like digital AI and all this genetics things. One of the notable things to note is that the private capital industry has reportedly more than 2.5 trillion of dry powder. So this means the money committed to funds but not yet deployed. So a lot of people are saying that there's going to be a lot of competition, especially in between the funds for the attractive deals. So this may dent some of these performances. Now, lastly, just want to touch a little bit on the fractionalized Lisco bonds. So as mentioned, this institutional Lisco bonds has been around for a long time. But the problem was that this was only available to institutions because it has been very hard to kind of, through various means, to actually issue this and to trade this. And bonds have always been a staple of a lot of the institutional and family offices. So in business school and all, the traditional asset allocation is 60-40, right? So what we are seeing now is that because of the emergence of technology, we see that instead of clubbing, and we have also seen that because the minimum ticket size for this is 200K, unless you're a private banking client or what, you probably will not have access to this. So for the mass affluent, there may be an opportunity here to actually fractionalize this down. So at CapBridge, we're working hard to look into this, and do stay tuned on what we are building up here. with that, thank you so much. And again, it's meant to be a brief overview, just to give you a broad thing of what are the various instruments and the developments within the private space. It has been said that the amount of money that have gone into the private space, and that's supported by data, has exceeded the amount of money going into the public space. I think this has been driven by a lot of the macroeconomics as what we talked about. And we do see this as a part of future proofing the portfolio, that it might be wise to look at really at some of the these investment products now, especially as we see some of the public market product getting compressed, and as part of a wider asset diversification strategy. So with that, thank you so much for listening. And wanted to move on to the next thing, which is that we're really happy to be working with and partnering with AERA Minterest to kind of bring and broaden access to these various asset classes in the private space. And I'll love at this point to hand over to Sharon Sung, who is the Chief Commercial Officer of Mintrest. Thank you so much again, and over to you, Sharon.
Thanks, Johnson. Good morning to everyone. I'm really happy and delighted to be here. So we at Mintrest definitely share the same vision with Johnson, and therefore very happy to share some of our thoughts of how we look at alternative investments in our neck of the woods, and how you as investors can also think about all the alternatives that are out there. So before we go into those instruments, I'd like to give you a quick introduction to Mintrest in case you're not aware of who we are. We are a digital investment platform, and we've been actually operating for a few years now. And our vision is really to democratize access to alternative instruments, and in particular, corporate private debt and structured debt solutions, as well as institutional grade real estate. And I will explain a little bit more what I mean by this later. But just for background, we have raised close to $200 million worth of financing for corporates. So that's the private companies who are not borrowing through the bank system. And most of the tenants, 77% of our deals have 6-month or shorter tenors, and we fund them very quickly compared to a bank, right? And average investment size is about 170,000. That's per investor on the platform. AERA came in as a strategic shareholder last year. And with this backing us, I think what we are very happy to see is a very strong real estate pipeline. AERA has become the largest APAC real estate manager, superseding CapitaLand actually, just for the assets under management within Asia. So I think this lends a very good credibility to our platform, and also the deals, because we do co-investment deals. We offer co-investment deals, and also the AERA team is behind us when we do due diligence on our transactions. So coming back to our collaboration with Johnson at CapBridge, I think we share the same vision of making this private investment access to everyone, right? So we break down investment ideas into smaller bite size. We give you access to the private capital markets, and this is both equity, which Johnson has already touched upon, and the debt side, private credit, which is what Mintrest specializes in. And with these two additional instruments in your portfolio, we believe that really helps to diversify your investment portfolio. So I'd like to move on to what we consider alternative investments. I think Johnson has already touched on this, so I won't spend too much time. I just want to say that traditionally, I'm sure most of you have listed shares, or to some extent some kind of fixed income, be it through perhaps unit trust bonds, unit trust fixed income with that as the main theme, or in other cash, right? But when we talk about alternative investments, we are really referring to investments outside of this traditional listed shares and unit trusts or mutual funds. So why is alternative investments growing, and what is the future ahead? I think the research that we've seen, again, just like CapBridge, we always want to look at data, right? So this is the projection as to the growth in alternative investments. And you can see on the left that Singapore is really expected to be way ahead in terms of the growth of accessing alternative investments. And I think that's should not come as a surprise, because Singapore has very much set itself up to be a financial center, but MAS is also very proactive in encouraging fintechs establishment in Singapore, creating sandboxes for them to operate in. So that should not be surprising within the APAC context that Singapore is expected to lead in terms of growth. But if you look on the right side, I think Asia Pacific growth, compared to North America or the other emerging markets like Middle East and Latin America, the growth within Asia Pacific is also expected to outstrip the other more developed and emerging markets as well. And not surprisingly, it's the millennials and the Gen X that will be adopting this most readily, right? Because a lot of this is about accessing it through digital means and digital platforms to reduce the transaction costs and access costs to investors in general. So this was the universe that I think we have presented. And for us today, we at the Minterest side, we would like to focus on the private debt portion. I think Johnson has already touched on the private equity and the venture caps and the unicorns that's available. So now we want to focus on private debt. What is private debt and how you can use it? So sometimes people think of private debt as banking for the underserved, rather than, we say unbanked just because they don't actually have an actual banking relationship. And one of the trends that's pushing this out is, as the KYC costs and operational costs for banks get higher and higher, they are increasingly readjusting their strategy at a group level, and they find that as a result, smaller borrowers are being dropped out of their lending program and lending strategy. So what happens is they turn to what we call the private markets, and that's where players like Minterest come in, right? We offer these debt solutions or loan solutions to these companies who are unable to go to the banks. So it ranges from working capital loans, invoice financing, mezzanine, or real estate financing. Now, some of these customers or borrowers that we do have on the platform are not completely unbanked. Some of them actually still do have traditional banking relationships, but they come to us for sometimes bridging loans or at an earlier stage of their growth development. And what drives that, again, comes back to the traditional banking model tends to take anything between 3 to 6 months to complete one KYC loan documentation negotiation before they finally make the facility available for drawdown, right? So sometimes these companies have to come to private credit providers like us. And what we do is we match them with investors who are willing to provide the liquidity for them. So why consider private debt? I think obviously the traditional wisdom is to, one, achieve portfolio diversification. But at the same time, when you look at private debt, it's always going to provide you with fixed recurring income, right? Because as is tied to a loan, the underlying loan to a corporate borrower, the interest coupons are fixed, and it can pay either monthly, quarterly, annually, but upfront that your return on this particular investment is fixed. There is sometimes security. So, if it's a real estate, for example, it's obviously going to be secured on the underlying building, the asset, but also for corporate loans, be it working capital loans that we have. Sometimes it's also secured against receivables, for example, or inventory or stock, or an all monies charge. Sometimes, and in the case of invoice financing, obviously it's backed by the invoice that has been purchased. And the payee actually pays directly to Minterest, and then we reimburse the investors when it on maturity. So I think what you need to consider for private debt is, one, is the borrower or in an industry that you like? What is the the credit profile that we've made an assessment, the tenor, and the security that's being provided. So a lot of this credit analysis has been performed by Mintrest, and a lot of the information will be made available when we launch a deal. But I think the way to think about this is we've disintermediated the bank, right? We've replaced the bank as an investor to fund these growing companies. And I think that's what makes this interesting for investors to look at, because aside from going into a mutual fund where it's completely diversified for you, you have the opportunity to pick specific either companies, sectors, or real estate at a much higher return profile. So I'll hand off to Alvin, who will go through the case studies of some of the deals that we've done on the platform in the past. Alvin, please.
Thanks, Sharon. Alvin here. So we move on to the next part of the presentation. So before I go ahead to the case studies, I will show you that at Mintrest, we offer a suite of private debt investment opportunities with various risk appetite, with the most secured offerings at 3.5% to the higher risk ones at 18%. So there are also varying tenors to suit the different time horizons for the investors, with our shortest deal at 30 days to longer dated ones at 36 months. So as mentioned previously, most of our deals are actually around 12 months or less. So on top of working capital loans and invoice financing opportunities, we also offer institutional grade investments that is not readily available to the typical investors. So for example, imagine with a minimum investment amount of $2,000, you can actually invest in a commercial building in Korea, or invest into a note that has an underlying of 24 properties across 6 Asian countries. So at Mintrest, we are also able to offer consumer loans as part of the investment offerings through our consumer financing arm, Mintrest Money, so which has a money lending license under Ministry of Law as well. So I believe that we are the only platform that offers this consumer financing at this point in time. So next, I'll move on to 4 of our concluded deals. Okay, so this client is a leading IT products and consumer electronics distributor headquartered in Singapore, with operations in 7 countries in ASEAN and India, and is 70% owned by a corporation listed in Shenzhen Stock Exchange since 2007. So this investment is actually a participation into a fully insured receivables financing facility issued by an international AA insurance company. So this client distributes key brands like Western Digital, Toshiba, Samsung, through a well-diverse list of 200 distributors globally, and as well as their corporate customers are like your Best Denki and Challenger and Lazada. So this deal is also structured with assignment of the receivables, corporate guarantees, personal guarantees, along with the trade credit insurance. So this offering is actually for a tenor of 3 months, with net interest of 4 to 4.5%, and the minimum investment amount is only $100. And it was also fully subscribed during our early access to our members. Next, I'll move on to another real estate deal. So Mintrest has teamed up with AERA Asset Management and Straits Real Estate, and launched our very first real estate deal on the platform in May 2020. So this is a co-investment with SRE into an Aussie 33 million mezzanine loan in respect on the 24-story high-rise residential development located in the west of Melbourne CBD. So this offer was for 3 months tenor with a rollover option, and net interest of 5 to 5.5%. The interest has been strong, and we have launched about 12 tranches so far. Next, I'll move on to this loan note. This is actually our largest fundraise so far of 30 million Sing dollars. This is actually a fixed rate note program referenced under AERA, and is staked into a diversified portfolio of 24 income generating real estate properties in 10 real estate funds and private REITs. This portfolio consists of 24 real estate projects in 6 countries, Singapore, Australia, South Korea, and Hong Kong, China, and Malaysia, across across 3 different asset classes. This is a rare opportunity to access AERA's real estate investment portfolio. In a short tenure of 12 months with a net return of 4 to 4.5% with semi-annual payouts. The minimum investment amount is $200,000. Next, I'll move on to the last case study. This company is actually a Singapore-based solar independent power producer that builds and operates solar PV systems for commercial, industrial, and public sites in the Asia-Pacific region. The client's major shareholder is actually a European Renewable and Green Energy IPP, invested by a European sovereign wealth fund as well. So this investment is actually into a secured financing with a source of repayment from the sales of the electricity to its clients with a debt service coverage ratio of more than 2 times on the loan tenor. This company has a good track record in the solar energy, and it has completed about 12 projects in Singapore itself, and the projects are currently financed by the Singapore Bank. This loan is actually secured with assets of LTV of more than 70%, and it offers, when we structure this, we offer a very flexible investment option to investors with various tenors, interest rates offered for each tranche as well. So this loan offering was actually for a facility of up to 5 million, varying tenors ranging from 6 to 18 months, with net returns of 6 to 7%, and the monthly interest repayment. So we launched 8 tranches so far, and it's fully subscribed in a couple of days. So with this, I'll conclude my presentation and pass it over to Daryl. Thank you.
Okay, thank you, Alvin. Thank you, Johnson, and thank you, Sharon, for sharing your thoughts, insightful thoughts on private markets and alternative investments. I'm sure it's always great to hear from industry experts because you guys are the ones at the forefront of the changes within the industry. Okay, so we've come to the end of the presentation session. We're going to kickstart some question and answer right now. So maybe just let me take a look at some of the questions that we have in the Q&A box. Oh, I see that Sharon is very on the ball. She's really gonna answer some of these questions live. Okay, so maybe I'll just start the first one. I have a question from Vivek Arora. First one is, give 3 reasons why these private companies do not go to local banks with lower interest rates and come to Minterest. Sharon, please. Yeah.
Thanks, Daryl. And thank you, Vivek, for all your questions. I've seen 3 of them, and I'm really touched that you've paid so much attention to our slides and you're quoting even slide references. So I will definitely answer all of them. So for your first question, I think the 3 main reasons that we've seen why these companies come to Minterest instead of going to local banks with lower interest rates, I touched on them earlier, but I will just expand on them here just for your benefit. I think so. The first point, which I touched briefly on, was the time lag. When you go to a bank, right? As I said, with that new enhanced KYC features, the MAS reporting, and the loan documentation, from the point in time when the borrower goes to a bank and provides all the information, and they do all the checks, and they do the negotiation on the loan documents with the lawyers, this process typically takes between 3 to 6 months. So, but from the time that the customer knows that they have a financing need, they may not be able to draw the money for 6 months. What we offer at Minterest is, if we deem that this is a loan that we can do, we made the assessment, we commit to you, or to the borrower rather, that we will be able to fund you within 2 weeks. So sometimes the borrower comes to us more as a bridging loan because they want to bridge the time that we are able to fund them to the time that they are able to draw on their bank facility. So that's one very good example, the time lag factor. Second reason is sometimes these borrowers fall outside what I call the bank lending program, right? So sometimes, for example, a bank could say, I no longer want to do development loans for property developers, but I will do completed assets. So for the time of the development period where they're constructing, they may not find a bank that wants to lend them money for the construction, right? So again, if we deem that this is something, so that's just one example, right? It could be a range of reasons why the bank does not want to finance that particular segment or industry, and that's the bank's strategy and the way they have structured themselves. And the last reason is when sometimes, again related to the bank, they do not want to onboard a new borrower in the event that they see that based on their assessment, they're not able to make a certain minimum revenue from this potential borrower. They don't even want to onboard the relationship, right? So increasingly, because of monitoring costs, operational costs at the bank, they look at each client and they think, if I can't make $2 million from this relationship in the next 2 years, I don't even want to start the relationship. So, and I've been a banker in my past career, so I understand how banks think, right? So that is another very common reason. So I think sometimes these companies also can be in the earlier stage of growth where there isn't a long enough track record for a bank to pick them up. So, they come to us and we offer them, different types of financing solutions with different security packages, right? So, Daryl, if you don't mind, I think what I'd like to do is also answer Vivek's 2 other questions at the same time, because some of them are interrelated.
Yes, definitely. Please go ahead. Yeah.
So, the next question was, what is mezzanine financing? So when we look at a company, when you assess a company, there is what I call the capital stack, right? So at the base level, you have equity, right? Because those are shareholders. They put in money and they expect a return that is related to the growth and the valuation and the profits of the company. And then you have what we call a mezzanine stack, which is a subordinated debt or junior debt, what we call junior debt. So it ranks above equity, but below what we call the senior debt, which is, typically senior debt tends to be the banks, or they have taken security on a specific asset or receivables, for example. So as they like to say, when push comes to shove, when there's an event of default, for example, or the company has gone into trouble, the capital stack is important because the senior debt gets paid off first, and then if there's anything left over after you've sold assets, taken out the cash still in the bank, sold stock, then after the senior debtors get paid, then the mezzanine debtors get paid, and then only if there's anything else left, the equity holders share what's left, right? So that's the capital stack. So when we talk about mezzanine financing, it means that you may have security, but you rank behind the senior lender in that capital stack. And then your third question on what is credit enhancement. Credit enhancement is something that we actually offer on some of our selected products for the credit loans. And a very good example I can give you is, when we finance receivables, some of these receivables have what we call insurance. So they've been insured by a company that says, okay, I've looked at the payees behind these names, and they could range from your big MNCs, Philips, Siemens, Western Digital, whatever, right? They look at all these people whose invoices, that means they're supposed, Philips is supposed to pay the borrower, right? This insurance company actually provides a guarantee that this will be paid out. So you pay for the insurance coverage, and that's what we call credit enhancement. So when there's a credit enhancement like that in the instrument, typically your returns go down because your risk goes down. So, Daryl, over to you. I'm not sure whether CapBridge would like to answer some of these questions live.
Okay. Just wondering whether you were going to continue a bit. Yeah, so we still have a couple of questions. I see that there's a question for CapBridge. I see that Johnson is typing an answer, so maybe I'll just let him continue. I'm going to put up a question from an anonymous attendee. So there's a question regarding, are all schemes straight debt financing, or do they include potential to convert debt to equity?
Okay, why not let me take that? Okay, so currently now, for all the instruments, all the offerings on the Mintrest platform, they're all straight debt. We have not moved into the conversion from a debt to equity right now. At this point in time, I don't think we are looking to do that in the near future, but we are exploring offering real estate equity for investors on the platform. And this will be addressed in the next webinar. So keep a lookout for it, and please register if you want to find out more about the real estate equity portion that we're going to talk about in the next webinar. Over to you, Daryl.
Okay, cool. Maybe just let me take a few more questions since you are running a little bit out of time. So I'm just gonna take another question. Okay, so there's a question on the default experience so far.
Okay, I'll take that. Oh, Sharon, you want to go ahead?
Oh, no, go for it, Alvin.
Okay, so far, we do list our default numbers on our website. It's actually we are regulated by MAS, right? So we actually required to report any 30 days or 90 days late from the client and to be published on the website on a yearly basis. So you can actually head out to the website to have a look at our track record, and you can see that our default numbers are there. Actually, it's not really default, it's just a non-payment in the next 30 to 90 days. But there are a lot of times when after deals like this where there's non-repayment, and we actually go against the client with what we have, our PGs, the securities in place that we have. And most of the times, there are times that we do recover the cost as well. And we revert that back to our investors on the platform. Now, Sharon, you have anything to add?
No, I think that's good. Thanks, Alvin.
Thank you.
I think, Sharon, there's a couple of questions you highlighted that you'd like to answer. So maybe just let me give a quick shout out of what the question is. Someone's asking whether the investments are available for retail investors, and how does Mintrest, grade the investment? Is it, like AAA, BBB, something like that?
So yes, I'm very happy to confirm that all the investments are available for retail investors. I would say only a very few are accredited investors only, but the bulk, like 90% of our deals, are available for retail, and it starts as low as $100 or $500, and obviously it scales up to whatever size that we're trying to raise. So if you're keen, please go to our website and register as a member to take a look at what we are offering. As for grading the investments, so yes, we do. As I said, we do due diligence on each of our deals. We have a credit analysis that's being performed by the RMs, the relationship managers. So we have our own system. So we call it a mint grade, right? So it starts with AA, A, B, C, D. Now you cannot map our AA or single A or B grades to what you may know as the S&P or Fitch or Moody's ratings of AAA or investment grade, what we call investment grade versus high yield. Okay, so there is no direct mapping or direct relationship. So we have our own methodology. We have our own algorithm that actually scores the borrowers, and we actually make the borrowers, the founders, because quite a few of them actually give us a personal guarantee as well as a corporate guarantee to back some of these deals. We score all of this in an algorithm that's being designed by us in-house, and we make the founders do a psychometric test as well, which tests their likelihood of paying off in the event that we have to call on the personal guarantee. So this is very much a proprietary credit scoring system. So more information is available on the website if you'd like to understand how we do it. I don't think I want to spend too much more time on the methodology at this forum.
Thank you. I think there's one last question for you, Sharon. So the question is, besides bond-like investments, which are offered on Minterest, will there be other types of alternative investments offered?
Sure. So yeah, when I'm assuming that this person refers to bond-like investments, you're referring to corporates, the corporate loan side. So aside from the corporate loans, which you can buy a piece of or invest in a piece of the debt, I've already, and Alvin's already mentioned that you can also invest in the real estate debt piece. So yes, that's still bond-like, but I think the difference being, that there's an underlying security, and quite often this would be something that is, very tangible to you, right? So in some of the examples that Alvin has given, maybe they're a little bit further away. They've been in, Seoul or in Australia. But what will be coming online is, I would like to very happy to say that we are working on a few Singapore real estate deals where it will be, when we mention the asset, you will know exactly where it is. And if you want to, you can drive past and, check it out to make sure the building is actually there. And, in some of these instances, it's an AERA co-investment, for example. And then the next, this brings me to our next new so-called product launch that's upcoming will be real estate equity, right? So we spent most of the day talking about private credit and private debt. Obviously Johnson's talked about the private equity market, which relates more to, companies, growth companies, unicorns, and all that. But what we are talking about will be real estate equity, which means when you buy into a building, you're buying into the equity portions. So go back and recall what I talked about, the capital stack. The real estate debt, typically we prefer to do the first priority senior lender piece. We do sometimes offer the mezzanine piece, which is something that is another deal that's coming up very shortly in Australia, that the mezzanine piece. So remember, you're a junior debt, but you need to understand the circumstances in which you buy that piece. And then the last piece, the equity piece, a deal is coming in our pipeline, but this means that you are going to be an equity shareholder in a particular building alongside quite a few institutional investors, right? Because this is what we mean by democratizing access to institutional grade real estate. In the past, the only way you can buy is, you club a couple of friends together and you buy a strata office space, right? So you could have gone to Suntec and bought one unit for 500 square meters of space, but even that would be, let's say, $5 million. So either you buy it yourself or you club a few friends together and get a bank loan and buy it. But what we're offering is, this is a large, significant commercial building. It has pre-committed lease occupancy, in a high 90%, and we're offering you a chance to invest into the equity portion. But of course, with equity portion, it means that you need to understand there is no fixed, coupon interest payments, right? So this is a segment of investment that we would like to, address and educate in our next webinar series. So please join us next Thursday if you're available, and we will be talking a lot more about that.
Okay, thank you, Sharon. All right, so I guess we're coming to a close now. We're really overrun with the time by a bit, so sorry to all the attendees who are present right now. I'd just like to close off by highlighting there was one question that Johnson answered about whether CapBridge is announcing opportunities for retail investors and how this will be realized. Just in case you missed it. Yes, we do have investment opportunities tailored for retail investors. There are certain MAS rules, that we are allowed to offer investments for RIs and not just AIs. And alongside with our partners, Minterest, certain Minterest deals are also retail investor accessible. So these are made known on our platform. So you can always just speak to your relationship manager, and we will gladly share more of this information with you. So with that, I don't have any other questions as well. We've come to the end of the webinar session. So thank you for your time this Thursday morning. For those of you who have signed up, I just wanted to highlight that, don't forget that this is a two-part webinar series. So same time next Thursday morning, we will be sharing on institutional grade real estate equity. So if you have any other questions, feel free to contact your CapBridge investor contact, and we'll float your questions up to Mintrest for them to be answered. Okay. So with that, let me just bring this session to a close. Thank you to all our speakers for your time this morning, and for all our attendees. Have a great day ahead.
Thank you, everyone.
Thank you.
Thank you.
Bye.
Bye-bye.
Bye.